U.S. markets extended yesterday's sell-off driven by declines in technology and software stocks. Investors focused on AI eating software theme. Let's go to Michael Green on this. He's chief investment strategist at Simplify Asset Management. Thanks for joining us today.
Oh, it's a pleasure to be here. Thank you for having me.
Is the software drag down that has been happening and the big sell-off the past couple of days warranted on what we know so far about AI tools?
Well, what we know is we actually don't know the answer to that. And so there have been a number of announcements, most importantly, the updated release of some of the AI software and its ability to code applications. This is increasingly creating a narrative in which companies are considering the reality that they could replace the SaaS type systems, the operating software that has become increasingly common, with AI-derived specific software at a much cheaper rate, lowering the cost of access and thereby lowering the barriers to entry into the space. We know there are real-world examples of this. I actually have seen direct examples of this. But it's a big leap from where we are today to actually seeing those contracts canceled, those contracts renegotiated, et cetera. The key fear that I would highlight in the software space is not actually so much on the public equity side, although we are absolutely seeing it hit there. The much bigger story is that there's a significant quantity of private capital that has gone into the software space, levering up these assets in a manner that others have correctly, I think, compared to the yellow pages prior to the global financial crisis, what seemed like a very stable, steady business that could accommodate significant amounts of leverage is now very much in question in terms of its durability. The yellow pages disappeared after the global financial crisis. That's the core question here with the AI eats software narrative. Are these going to just disappear as businesses?
That being said, you do see it as too broad of a takedown right now.
At this point, we've seen the speed and severity of the sell-off relative to other assets suggests to me that either we will see a catch down in other assets or we're going to get an opportunity to at least trade on a relative basis in the software space. Very rarely do these things move in a straight line. As I said, there's a lot of distance between here and formal adoption of these strategies and the replacement of these individual components.
Okay, is the narrative different for bigger tech, so away from software companies? Because tech also has been sinking in a very big way. We've had some earnings reports that haven't been bad. So what has changed in that narrative?
Yeah, I think you're hitting on a number of stocks as you pull them up on the screen. I think IBM would be a good example where they have a significant services business that ultimately could theoretically benefit from providing the resources for reprogramming these systems. In and of itself, I think it's important to recognize that anytime you hear this sort of narrative, there is an element of couching towards it and direction towards it. And so it's very much in the interests of the LLMs and AI companies to share this information, or at least these concerns. It certainly facilitates investments in those. Now, with that said, one of the points that I highlighted for you is that software as a broad category has actually underperformed the S&P 500 really since the tail end of 2020. That was the peak of we're all going to work from home. We're not going to have offices. Software is going to replace everything. Our world is largely going to dematerialize in one way, shape, or form. And there have been repeated cycles over that time period that we have seen the recovery of software, et cetera. Again, I don't know the answer in terms of whether AI is going to replace the existing software businesses, but kind of the larger companies like the IBMs, et cetera, of the world are likely to have a very different experience than smaller purpose-built software targeting areas like dental care or hospital management or auto parts management. Those, I think, are going to be the areas where we may actually see some real concerns about the durability of the existing business models.
So do you expect a continuous rotation away from tech as we've been seeing for the past, I guess, almost like 6 months?
In general, I tend to be negative on the whole theme of rotation for the very simple reason that the vast majority of people simply invest passively. They will buy the total index, whether that's the S&P 500 or a total market index like a Vanguard total market or BlackRock total market index. That makes it very hard for rotation to occur except in these episodic periods when the discretionary allocators are moving their positions. Once they move their positions, the market goes back to doing what it was doing, which is putting money into broad market averages. That tends to freeze things in place, tends to benefit the largest companies and slightly more volatile companies like large technology companies.
Okay, I do want to get to mid and small caps, which we have seen more money go into. What do you foresee for both mid and small caps?
Well, I think unfortunately we are seeing incredible divergence between the profit trajectory of the largest companies in the S&P 500 and areas like the Russell 2000. Actually, interestingly enough, the Russell 2000's aggregate generally accepted accounting principle-based earnings have turned negative now. That is a major divergence from what we've seen within the S&P 500. And it suggests that what's colloquially referred to as the K-shaped economy is now increasingly spreading into the corporate sector. I'm sure many of your listeners with small businesses are well aware of the challenges that smaller businesses have. When we start talking about the Russell 2000 or even the mid cap, these are quite large businesses in aggregate, but they still don't have the pricing power or the capacity to determine their own direction in the way that many of the truly giant mega caps have.
Michael, I've got to leave it there. I'm out of time. Michael Green's Chief Investment Strategist, Simplify Asset Management. Thanks for your time.